Good morning, Wall Street. In this educational video, we're going to talk about trading using the stochastic indicator. And we're going to look at a stock on a daily basis, and we might as well pick Cisco since it had such a great day yesterday. And we're going to see how we can trade this stock using the stochastic. Now, the first thing we want to do when we're picking a stock to trade short-term with is to check its beta. And what we want is a stock that has a relatively high beta. And the reason for this is that if we're going to be taking buy and sell positions in the stock so that we can couple our bias on the market with the direction that we're going to trade in on a stock, it all comes down to bias setups and triggers. So let's see how we do this with the stochastic indicator. First, we're looking at Cisco and we're going to check out its beta. Scoot up here a little bit to our program, and the way we do it is we have a link that goes right to the web and gets us onto Yahoo's site for Cisco. And we want to go down to key statistics, and we're just going to scoot over and check out its beta, which is 1.19. Beta of 1 would mean that the stock moves up and down in tandem with the market. Anything higher than 1 means that it should move up a little bit more and move down a little bit more with the market. 1.19, that's basically 1.2. So if the market moved up 10%, we would expect Cisco to move up 12%. If the market dropped 10%, we would expect Cisco to drop 12%. So here we are with a bar chart of Cisco. Let's add in the stochastic indicator. And we're simply going to use the standard stochastic indicator. You can find this on any software programs. And for levels of extremes, we're using the 80 level on the high side and the 20 level on the low side. And for a buy signal, what we want to see is something below 20 and then a movement above 20. That's your buy signal. And for your sell signal, you want to see above 80 and then move down below 80. That's your sell signal, this movement below the 80 level. Is that all you got to do is wait for these signals and you're going to make a ton of money by taking these buy signals and taking these sell signals? If only it were that easy. The problem is that when the big picture is moving up, you're basically getting creamed on your sell signals here. Each sell signal just gets you in at not a very great period of time. You're fighting the trend. And you get into a situation like this where you get a sell signal, sell signal, sell signal, and it's just handed to you. And that's the problem with an indicator like the stochastics. Deciding which trades to take and which trades to avoid. And we do this by establishing some form of bias. There are a number of indicators you can use to determine what your bias is going to be for a stock or the market or whatever. So I'm going to show you one that we have. It has to do with volume. It's our Erlanger volume swing indicator, but we're going to do something a little interesting with it. So let's just put it up there. We're going to use the standard 14-period interval for the volume swing. All right, now we could use the volume swing as a trading indicator in and of itself, but what we want to do is use this as a bias indicator. And our philosophy about using bias indicators is that they are derived from a larger interval than the interval you are trading. So what we can do in our software is that within this daily chart, we can change the interval of the volume swing from a daily to a weekly indicator. So let's do that. And we're just going to change this to a weekly indicator. So now what we're concerned with from a bias standpoint is very simple. So long as the weekly volume swing is above the 0 level here, which is this black line, our bias is going to be positive. And if it's below the level, then our bias is going to be negative. We're still looking at a daily chart. We're still looking at a daily stochastic. But this is going to dictate what our bias is going to be. Let's turn on the crosshairs. Now, sometimes these signals just nail it, like right there. I mean, that's a great buy signal. You're below 20, you come up above 20, and bias is positive, just barely, but it is positive. So you're off to the races there, and that was a great trade. But sometimes you get these little double dips. In fact, you get them frequently enough so that you need to design a trading strategy to deal with that. That's determined by using units of trading amounts and by setting stop losses. Most of the time you're getting double signals here at the bottom. This buy signal there and that buy signal there, and we see that a lot in the past. For example, if you're going to commit $20,000 to a trade, then consider that to be 2 units. So half of that would be 10,000. So we'll put 10,000 on the first signal and then set a stop loss below the previous cycle low, which is back here. So you put a stop loss, and in fact I just a hair below this level, so I'd put it at 17.6. So you get the double dip, your bias is still positive, clearly positive here, and you have another signal, so you put in the other unit, which is another 10,000, and again you're setting the same stop loss level at here, and you're off to the races. Now, where do you get out? Well, you can get out based upon how long you're in the trade. You can get out based upon any change in your bias. You can get out based upon the next sell signal, which would be here. You're not taking this as a new position. You're simply using this sell signal as a way to get out of your long trade. Now, along the way, if you get a lot of oscillating within the middle portion of the stochastic, you can use this little upturn here as a level at which to raise your stops from this level to that level, which would be the previous low cycle following this dip. And that's your exit point. Now, why don't we take a short trade here? Because your bias is positive. So you eliminate all this back and forth messy stuff about taking short trades in a stock that has a positive bias that's moving fairly well in the marketplace. You just don't want to get involved with that. You dip below this level just very briefly, so you had another buy signal right there. Your bias is positive. Your previous cycle low was here, so your stop was at 20.8, let's call it that. And your sell signal is right there, around the 23 area. You had a double dip here. Again, your bias is still positive, so we're thinking long. You dip below the 20 level, you moved above, so you put in the first unit, which is $10,000, and you set your stop loss at the last cycle low, which was right there, right around 22.3. So very close, very tight stop. And as we said, we like to put the stop in just a little bit below the previous cycle low. So it really went down to the wire for us, but that stop wasn't triggered. So you're long 10,000 here, and you're adding another 10,000 here the day before yesterday, and you're off and running. Now let's step the Wayback Machine and look at some other trades that are set up here. Now let's move back further in time when the bias is negative. So now what happens when we're in a negative bias situation? We're only going to take short trades. So let's look at those. And that really didn't get above 80 right there. It would have been a nice trade, but that didn't quite do it. So we're waiting for this move, and we're short here. We got a signal there, and you might set a stop loss at the previous cycle, which would have been right there, 19 and change. You have 1 unit short there, another unit short there, and you're out there. That was a quick trade. Looks like you only have 1 unit to go short here, and that was also a quick trade to the downside as your cover right there. This is the first in a 3-part series on the stochastic. In the next video, we're going to change the stochastic a little bit, trying to get meatier trades, maybe not trade so frequently, and look for perhaps the juicier trades to take. That should be interesting. And in the third video, we're going to take what we've done in the first 2 videos and look at it on a short-term intraday trading basis. That also is going to be fun. Hope that helps. See you next time.